thinking about the questions that I would be able to ask today, and I was in the green room after a Today Show segment. I had a few minutes to kill after Monday Night Mortal One about a week and a half ago, and so I opened my computer and I surfed through a few different websites. I checked the New York Times for new headlines, I checked Gilt Group for new sales, and I headed over to CNN Money to see what was going on with the market. The top story that they had that day was a big one. Stocks had hit a 3-year high, and it was followed by several other pieces of what I think we can all consider good news. Apple had doubled its profit, IBM and other companies were benefiting from the weak dollar, but I kept on reading. And what I found was interesting, because slightly lower on the page, although it was the same page, the news was a little bit more on the dour side. There was a story about the uneven housing recovery. There was a piece about how tough it's become to actually get a mortgage. And there was one that was actually entitled, "You're Poorer Than You Think." I felt a little like a character out of Dickens, right? It's the best of times, and yet it's the worst of times. And moreover, I have to admit that both sides of the coin really resonate with me. The Women Presidents Organization recently fielded a survey of its members, and what they found was that 67% feel really optimistic about the rest of 2001. But the rest, the other 1/3, they're not quite sure. And 4 out of 5 are feeling pretty good about 2012, but the remaining 20%, they're not so sure that we are out of the woods yet. I agree again with both. Things feel better, right? Stores are a little more crowded, restaurants are certainly more crowded, popular resorts are seeing their fall calendars book up. I'm sure that some of you feel that things are getting better because you have taken action, maybe at work, maybe at home, to make them better. But to say that the markets and the news are volatile is an understatement. Unemployment is still frighteningly high. The end of a recession, but I think particularly this Great Recession, the longest since the 1930s, which the Ivory Tower economists actually decided really ended in June of 2009. Maybe one of our panelists can explain that one to me. It clearly is not an event. It's more of an unwinding, and it's more of a process. And going through that process, as well as the stock market bubble and burst and the housing market bubble and burst that preceded it, has forced all of us, I think, to confront not just the tenuous nature of success, but the very meaning of money in our lives. My own Roper study of money and happiness showed that even all of you sitting here today, and we are successful, affluent, educated, employed for the most part. Even people like all of us, we worry more about our money and our finances than about any other aspect of our lives. We worry about it more than our jobs and our kids and our health and our marriages, and even more than our weight and our appearance. It's true. The corporations that we all work for, the friends we hang out with, the boards we give our time to, they may see us as calm, laughable, but I know people like us worry. And so this afternoon, we are going to try to dispatch with some of those worries, and we're going to do it with the help of a fantastic panel that combines to bring us a remarkable perspective on, as the title of the session said, everything from Wall Street to your wallet. So let me introduce them. I'll start closest to me. Binyamin Appelbaum. Binyamin Appelbaum is a domestic correspondent for the New York Times. He's based in Washington, D.C., and so he writes about the intersection of business and government. He previously worked at the Washington Post, the Boston Globe, and the Charlotte Observer, where his coverage of the foreclosure crisis won the Georgia Folk Award for Economic Journalism, the Gerald Vogt Award for Distinguished Business and Financial Journalism, and He was a finalist for the Pulitzer Prize for Public Service, and he's only 10 years out of Penn, which makes Karen and I very jealous, I'm just saying. He majored in history while he was here at Penn, but admits that he spent most of his time at the Daily Pennsylvanian. Next to him, Karen Finerman, who I'm sure many of you recognize. She's co-founder and chief executive officer of Metropolitan Capital Advisors. She fills a uniquely influential role on Wall Street as a top female hedge fund manager. They call her the chairwoman on CNBC's Fast Money. She was recently named one of 50 leading women in hedge funds by the Hedge Fund Journal, one of the 25 most powerful women in finance by U.S. Banker, and Trader Monthly, another publication started by a Penn alum, called her Wonder Woman. Karen is committed to educating others, particularly women, on investing. She began her career as a trader, joined DLJ Securities, where she became lead risk analyst for the risk arbitrage department, and then co-founded Metropolitan Capital Advisors. She received a BS in economics from Wharton with a concentration in finance, and today serves on many boards, including the Michael J. Fox Foundation for Parkinson's Research. She's a trustee of Montefiore Medical Center and the mother of 2 sets, not just one, 2 sets of twins. She's tired. Dr. Sigal Barsade is the Joseph Frank Bernstein Professor of Management at the Wharton School, where she has been on the faculty for 8 years. Prior to that, she was on the faculty at Yale University for 10 years. We're not going to hold that against you. She is an award-winning researcher and teacher whose areas of expertise include emotional intelligence, organizational culture, leadership and top management teams, emotions in the workplace, and group dynamics. Her academic experience enables her to integrate cutting-edge research tools and knowledge into her consulting practice, and she's served large corporations including Del Monte, GlaxoSmithKline, Merrill Lynch, and Levi Strauss. She has been published in top academic research journals and interviewed and quoted by the Wall Street Journal, the New York Times, Business Week, Oprah Magazine, Fast Company, and dozens of other publications. So welcome to all of you, and thank you for doing this today. I am going to sit and join you over here, but I want to start because you come from such different vantage points with a large question, and I'd like each of you to spend a few minutes answering it. Where are we right now, as individuals are concerned, as far as our finances and our financial well-being is concerned? And Binya, I'll start with you.
When I came back to Penn 5 year ago for my 5th year reunion, I was working at the time in Charlotte, North Carolina, and Charlotte was a boom town. 2 of the nation's largest banks were based there. It turned out that banks could make more money than anyone had ever suspected before. And Charlotte just didn't know what to do with all of it. The city government had just opened a man-made river for whitewater rafting. Built at public expense because they had so much money they just couldn't figure out what else to do. And that's what it was like at the time. It felt like we discovered some new set of secrets and things were just better and going to stay better than they'd ever been. Where are we now? You know, I still think about it in terms of Charlotte. One of those banks has completely disappeared. The other is struggling badly. That's Bank of America. Home prices in Charlotte have fallen dramatically. Unemployment has shot through the roof. Even as the economy has begun to recover, life there has not returned to anything like normal. People have jobs that pay less than the jobs they had previously. They don't get the same kinds of bonuses. They can't buy the same kinds of things. And they don't have that sense of certainty that comes with the belief that things are on the upswing and going to stay that way. So where are we now? Well, you know, it's not the best of times. It's not the worst of times anymore. We were there a couple years ago. It's somewhere in between, but things are not nearly as good as we thought that they would be in 2011. I think that's likely to stay that way for the foreseeable future.
And Karen, from a Wall Street perspective, do you agree?
No, from a Wall Street perspective, I think there's a real sort of bifurcation. There is the part of the country that you talk about, which is pervasive. Then there is the Wall Street recovery, which in so many areas has been nothing short of astounding. If you think about what was happening in 2008, as companies, one after the other in a domino fashion, were just going under, the debt markets are completely revived. The deals getting done were unthinkable in 2008, both in their number, in their scale, in how loose some of the covenants have become. That's been extraordinary. And the stock market has also rebounded. I mean, if you're in New York City and you're out and about, I mean, restaurants and the economy in New York City, in a lot of ways, has really come back. And when you think also about corporations, a lot of them have survived. Not only they've survived, they were in their foxholes, they built up tremendous war chests of capital. So there is so much money now on company balance sheets, and there's so much money available to borrow. And with rates where they are, the hunt for yield is so profound that deals that are unimaginable are getting done. So that's a very different scenario than what you're looking at. But you have this other part of unemployment seeming to be intractable. I don't know how we get out of this shift from the manufacturing economy, which we've already started shifting away from, to what next, services or what, I don't know. That is still in flux.
And Sigal, you look at things from a different perspective. Emotionally, where are we?
So it's funny, emotionally I would say we're kind of lightly bipolar. And which is represented by both the way you started, Jeanine, which is I've got a piece of paper in front of me, and at the top I've got all this great news, and at the bottom I have such not great news, and then we've got Binyamin saying, oh my God, whitewater rafting is dead as we know it if it's manufactured, and then we've got Karen saying, are you kidding? We've got all this money, and I think as people and as humans and consumers and employees, we're saying, I'm not sure. I want to be happy, but I'm not sure if I should be upset. And the thing about the psychology of fear is that people can't stay in it long term, which is actually a lovely thing in terms of the endowment of the human spirit. And so we really did hit a tremendous psychological crash a few years ago, and people really were incredibly down. And I think that what happens is at some point they just can't hold it that long. And so the glimmer of hope kind of comes in, and then there's some positivity that can lead to that, because a lot of this is about perception. And it's what news story are we paying attention to? You know, which of these two panelists, even as you listen, which were you focusing on? You know, and were you like, oh yeah, this is just, or wait, you know, part of that's going to be your personality. But I think that people right now really they're in the middle. They're not in the depths of despair. They're not completely giddy. I think they're cautious and emotionally cautious, but they're certainly nowhere near where we were.
Have we come full circle in resetting our expectations for where we are actually headed? And I'd love to sort of deal with this both from an emotional perspective, but also from a financial perspective. As people try to build their portfolios toward retirement, are we expecting the things that we were expecting 3-5 years ago, and is that rational? Sigal, you want to start?
Sure. Well, the research on people's decision makings and set points shows that we consistently recalibrate them. And so you know, to answer your question right now, do people feel like they were before? No. And I think people, for example, towards retirement, there's real fear about whether the system can sustain in ways that I don't think was as salient to folks before. But in their daily lives, we do recalibrate in terms of our happiness about that. So it could be that before you expected to get the 6% bonus, and now you get the 2%, and you say, well, at least it was better than when I got 0. So we're fairly functional in that way, actually.
Are the markets functional, or do you see, Karen? Do you see the markets right now as being frothy?
I think there's areas of the markets that are somewhat dysfunctional. If we look in the last 2 weeks, and you think about the silver trade. I don't know how many of you follow silver. So 2 weeks ago, yesterday, silver was nearly $50. If you look at the SLV, which is an ETF, which is also a proxy for, it's an instrument that anyone can use to get long silver. And it became a proxy for hysteria. So the silver ETF goes to $50, and then all of a sudden, somebody rings the bell, whether it was the increase in margin requirements, or selling from Soros, or hedging from Carlos Slim, whatever it was. We now look at this morning, I think the SLV was at 33. 2 weeks later. That is a tremendous change. And so there are some pockets of the market that are beyond frothy, and then there are other parts of the market that are left for dead and are tremendous value. So again, it's bifurcated.
There has been, dominating the headlines just like silver, there's been a ton of talk about financial reform, about the Consumer Financial Protection Bureau, about different measures that have been put into place to help ordinary consumers and investors. Are we any better off today than we were when this whole bout of trouble began?
I think it's important to understand just how broken things have become. You know, the last 3 decades, we've seen this steady shift toward asking people to take responsibility for their own financial decisions, deregulating many of the transactions that previously had been tightly controlled by the government, turning responsibility for retirement savings, for personal investing, for all manner of things over to people, and then freeing the companies that sold them to get whatever terms they could. And it turned out that those companies were a lot more clever than their customers, and lots of people ended up in deals that were extremely disadvantageous to them, you know, buying things they couldn't afford, agreeing to things that weren't in their interest, paying fees that the only reason for them was that it was possible to collect that much money. So we had a badly broken system, and it needed to be fixed. Are we better off? We're probably a little bit better off. But really the question is, has enough been done to get us to a point of sustainability? And I think that's still an open question. You know, there's what's happened in Washington so far has been very preliminary. It's the first stage in a long drama. The financial industry is you know, fighting to minimize the impact of these new rules. And I think it hangs very much in the balance whether the system is going to be sufficiently better to really address the problems that have come into existence.
What has to come down the pipe for it to be better?
Well, you need a couple. I mean, you need the political will to actually follow through. Many of these solutions are not complicated. Everyone knows what they are, but you need the political will to actually implement them. You know, issues like whether the people who sell you financial products need to take your interest into account, or whether it remains perfectly legal for them to, you know, to sell you something that isn't good for you. Is that okay? You know, there are a number of areas where the law is now pushing toward a standard that would require them to act in your interest. But we haven't seen that implemented yet. It ought to be.
I'm always amazed by the fact that we're smart people. Many of us are smart people. And to a certain degree, if we thought about it, I think many people would indeed know better. But Sigal, I'm wondering, why do we allow ourselves to make the same really dumb mistakes where our money is concerned again and again?
That would take longer than an hour and a half, but there's so many reasons. As you started with, money is something that's very it's a hot button. It's something that's very core to us and very anxiety producing. And people's tendency in general is to revert to the known, particularly when they get anxious. So, funnily enough, there's something called threat rigidity. And threat rigidity, in the research, what we found is that when people get under threat, they actually become more and more rigid about how they go about making decisions. And actually, my favorite story about this is about a guy in a catering firm, Hans, and he was a fabulous meat cutter. And he did such a phenomenal job of cutting meat that he was promoted, and as it will be, he was promoted, and became head of this entire huge catering thing. And one night, everything was going badly, and the guests weren't getting served, you know, no wine was coming out, the thing was a mess. And everybody's looking for Hans, who's the leader, And where do you suppose Hans is? Right? He's in the back cutting meat as fast as he can because he's the best meat cutter around. That's what, when we get under threat, we tend to get rigid, we tend to not become creative. And so as it relates to our money, what we do is we have, in general, what we found is that people have a fairly set, ingrained view or set of beliefs about how they should spend their money and how they should go about dealing with things. And so as the scarier it gets, the more they tend to do that, and they tend to not want to do what is in their mind innovative or creative. Let's try this new solution, let's try this new thing. No, I want to try what I know because this time it'll work. And so that's part of the reason. There's a lot of other things which I think we'll talk about later in terms of social dynamics and how everybody around us, and particularly with the social media, influence us to also kind of operate in a herd. But individually, it's because we tend to like to do what we feel comfortable with, whether it's right or wrong.
Karen, I know you've spoken to a ton of women's groups. Karen and I met for the first time, not here, but at the Y in New York, where we were both speaking to a group of women. And I know you often get asked the question, so how do I protect myself? I mean, is it a matter of finding the right advisor? And in this Madoff climate, how do you do that?
Well, that is a good question. Yes, it's either you can do it yourself, which is very hard for some, but definitely the road for some. They want to do it themselves. Or you can find an advisor, and there's a lot of good places to go, but you've got to meet with several to know if there's a fit. I think particularly for women, it's more important that the fit be there, actually, because it's women, for some reason that I don't fully understand, have a harder time expressing what they want or what they're afraid of or what their goals are, or they don't want to have someone be condescending to them. So for a lot of women, that's a hard relationship. I think you got to try to find one, and you have to look at a few before you. It's like dating. You don't just marry the first guy out there. You got to date a number of them, and that's really important. And I think educating yourself and being aware of where you want to be and what's realistic and how to get there is really important. And I think one thing OA did was help to reshape goals, to your earlier question, for a lot of people, not just women. But you need an advisor that's going to understand where you need to be and help you get there.
Do you want to weigh in?
Just, whenever I hear these discussions about how people can do better by themselves, I guess the question I note is that some of the world's most sophisticated investors got robbed blind. We're living in a time when the rules are written in such a way that you really cannot protect yourself completely. There are things that can be done that are legal that will hurt you, and there's nothing you can do about it.
Diversify. That's the only thing that you can do. You may, no matter how great your due diligence or whatever, sometimes it's just a fraud or they don't work out. But by being diversified,
not just among investments, but among managers.
Among managers, right, among investments, among asset classes. Even now, something we never thought of when I was here would be diversification in terms of currency. You want to be all in dollars. That was a totally not relevant question then, and it is now.
So a story in Smart Money magazine in the last week or so talked about the biggest risks to your portfolio. And some of them we can control, and some of them we can't control. But I wanted to go through them and talk about those things that we might be able to do just to get a leg up. Inflation and interest rates, among those that we can't control, are the biggest, among the biggest on the list. I know, Binya, you've written about this very, very recently. How concerned should we be right now about both of those things?
In the short term, not very. I know that a lot of people have probably noticed they're paying more for gas and more for food, but if by inflation what we mean is that prices are rising broadly, the truth is that just can't really happen unless people are having more money to spend. And as many of you may also have noticed, wages are not rising. So there's a real hard check on inflation, on broad-based inflation right now. And the expectation, and we may have started to see it in the last couple of weeks in some of these commodities markets like silver, is that these recent spikes in prices are going to come back down, and that for the next for the medium term we're not going to see pronounced inflation across the economy. The economy is simply too weak to be driving higher prices. The one interesting counter-argument to that is the possibility that after years and years in which the primary impact of China on the American economy was to make everything cheaper, we may now have reached a tipping point where China is going to start to make things more expensive. Because as demand for materials and for finished goods rises in China, their market and ours in areas where we're buying the same things may start to change that dynamic so that they are pushing up our prices. That's the one risk factor. It's still pretty small. It needs, given the area of overlap, you need to see pretty significant competition there before you really see inflation. So I don't know any experts who think that's something you ought to be worried about in the next year.
Karen, do you agree, or are you buying China in some way we all want to know about?
Well, we do want exposure to China, we do want exposure to India, but we just don't feel comfortable buying equities over there. So what we try to do is get our exposure through U.S. companies, multinationals, names that you've heard of for sure, that have really great businesses there. For example, Yum Brands. Probably some of you all heard of. They own Taco Bell, Pizza Hut, and KFC. KFC is gigantic in China. So 33% of Yum's business now is in China, and I'd much rather be invested in that than a Chinese equity. I don't know if you guys happened to see what happened in Yahoo yesterday. Yahoo announced that some of their assets had been taken. I don't know what other word for it. And they were not fully aware of it at the time, and they're looking into it. And they hope it doesn't happen again. And this was in China, and there was some technicality about their business Alipay, which is very similar to PayPal. And just hearing about that, how these assets could be usurped without their knowledge, is very scary to me, and it makes me very uncertain about being directly in the Chinese market. I feel like I'm the patsy. I don't know what's going on here. So I like to be there in companies like Yum. Let them do it. They're gigantic. Or Walmart, names like that, where I feel like I can be comfortable with the financials here.
What about interest rates at this point? I mean, where are you on interest rates going up? When will that happen? And how are you dealing with that in your portfolio?
I think it will happen either at the end of this year or early next year. I thought it would be the end of this year when Trichet at the ECB was more hawkish about trying to contain inflation in Europe. He's since backed off that a little, which gives Bernanke a little bit of room to not be very hawkish. I think the end of QE2, I don't think will be particularly eventful. And I think our economy will improve, and I actually think tightening of rates would be a good thing here. So how do we protect it? We are not long anything in the long end of the Treasury curve. No one I know is, and it would have been a great trade for the last 8 months.
Then there are risks that we don't even know are coming. Right? We've got wars, we've got natural disasters on what seem like a weekly basis. How do we deal with those things as investors? And how do we, Sigal, deal with the fact that we just don't know and there's no way to know?
Again, from a psychological perspective, this becomes very, very difficult, because if you're trying to assess risk, and you could spend all your time on weather.com or poli-sci websites, but fundamentally there are these exogenous factors that you just don't know. So the question is, well, what do you do about that? I mean, and here's where personality comes a little bit into play. There are some people who have what's called high trait negative affectivity, which means they generally tend to be fairly anxious, hostile and irritable. And
that's quite a euphemism. What is it?
Trait negative affectivity. Yes. Actually, it's defined as high energy and unpleasant. Really, is
Nobody here.
No. But if you're that kind of investor, or you're going to worry a lot more about that kind of stuff, and you're going to try to figure out, all right, well, what do I do? And you're going to spend a lot of time perseverating. The problem is, you really just don't know. I mean, these are things that, unless you happen to be an expert in that domain, even then, you just don't know. Then there's, by the way, at the other end is something it's called low trait negative affect, and what I like to call the California condition, which is sort of calm and serene and laid back, and a little bit less anxious. And I think the bottom line comes down to trying to, and it gets a little bit to what you two were talking about before, you know, yes, there are things you can't protect against, and that's maddening, right? And there are ways to try to go about that either governmentally, hopefully, or individually, but ultimately, what can you do? You can diversify. You know, you can try to do the tactics, one, that really are gonna make you feel better. I would highly suggest that. In fact, I do a lot of work with financial service firms and with the folks who go out and sort of sell these products, and they talk a lot about how when they deal with their clients, you know, it all so much depends on the client. I mean, you don't want to do something really, really stupid, but that's where getting the guidance of a financial advisor or two can be helpful to you. But ultimately, if you go with what makes you comfortable and you do the things that are considered to be sound and rational, like diversifying, like making sure you're kind of doing the basics of where you're going to be, you're going to find yourself at least in a more even spot. Now, is that going to make you a ton of money in the huge way that really taking the major risks? Well, no. So there is a cost to that, and that's where the personality piece comes in, because some people want to try to take more risks. But ultimately, you can't control it, so you have to figure out how you're going to live with that.
Can I add one more word on this,
Please.
which is margin of error. You know, if, like most Americans, you're borrowing 90% of the value of your house and spending more each year than you make, which the average American was doing during the boom, then any setback is going to hit you very, very, very hard. And a lot of problems can be avoided if you're not pushing to the very edge of the envelope. It limits your ability to get massively rich, sure, but it means that when setbacks arrive, you're better protected.
A lot of what Sigal was talking about really comes down to confidence, which was one of the very, very big buzzwords that we heard from policymakers and bankers during the financial crisis. I'm wondering from your perspective and also from Karen's, how confidence affects decisions in the real economy and whether it's appropriate for the government to be in there trying to inspire confidence.
It's one of the most powerful tools the government has in its toolbox because it has such profound effects through the economy. The decision between, you know, a businessman who thinks it's time to buy new equipment and start hiring people again, and a businessman who's not sure that that moment has arrived is the difference between an economy that's growing and an economy that's not. So it's hugely important, and if the government can find ways to tip that balance, that's one of the most effective things the government can do in trying to restart the engine of the economy. So yeah, it's really important. It's hard to do, but it's really important.
How do you see it in your world day to day?
I completely agree with what he's saying. I used to look at the consumer confidence number and think, it doesn't measure anything, there's no orders, there's no backlog, what does it measure? But now I really have come around to thinking it is a very important metric because it helps that CEO make that decision to buy that equipment. But I also think what you said about the government, in March '09, when we really were on the precipice of complete financial collapse, the government put out this white paper which basically said, we will not let any big institution fail. And people were skeptical because of what had happened with the same weekend. AIG they saved, Lehman they didn't, and how do we know that they're going to save whoever may fail? But they really were pounding the table. We will not let any institution fail. And investors started to believe that, and because that belief built momentum, a lot of companies like Bank of America were able to sell shares to the public to save themselves. So it was the public's belief in their ability to survive that allowed them to survive.
A lot of that comes not just from the government, but from the media and the way the media spins whatever it happens to be talking about that day. Sigal, I want to start with you on this, although I know we love to talk about ourselves, so we'll go forever on the media. But I know you think the media had a lot to do in a blaming sort of way with the financial crisis.
I move slowly away from
No,
my
I
other
noticed
panelists. Yeah, actually. So one of the things that I study is something called emotional contagion. So I do a lot of work around emotions in the workplace. And emotional contagion is the phenomenon that we literally catch each other's emotions, and confidence, by the way, would be part of that, like a virus. from one to another, both negative emotions and positive emotions. Now, what makes emotional contagion so insidious is that what we found is that we generally don't know that we've caught it. So what that means is that if you're feeling like, oh my God, this is the best economy ever. I'm gonna buy the boat and the house and the second house, and you think you're being completely rational and this came from you, and you don't understand that actually it's because you've caught it from the people around you, or the opposite, if you're feeling anxious. And by the way that we catch it is primarily nonverbal. So literally, there's something called behavioral mimicry. So if I smile at you, you will generally smile back at me if I do it for long enough. And then once you've smiled through facial efference and other things, you will actually start to feel the emotion. And actually, a quick way to increase temporary good mood and confidence is literally, I know it sounds weird, and perhaps do it where nobody can see you, but if you just smile, like, it can be fake, actually, but you will start to feel better. So, but all of this is primarily subconscious. Now, it can be manipulated consciously, but as recipients, it's primarily subconscious. So what happens is, you're going about your business, and suddenly your friends are, let's take the economic downturn. People are looking more upset. Fine. Well, it used to be that the people who are upset around you, are your more local area, maybe it's your local paper, when you turn on every single station and the more interesting news is, wow, this has failed, and now that's failed, and this has failed, and this gets to exactly what you were saying just before. Much of economy, particularly a free market economy, is perception. It's what we believe it is, within reason. And so my concern at the time with the big crash with the media was that by having all of these stories, what was happening, it was feeding in and of itself. So where somebody may have been marginally worried, well, they see the TV, and the TV is like seeing all of their friends amplified. And you see it enough and enough, and you say, wow, I really am worried. And then what do? You don't buy the refrigerator you were thinking of doing. You do start to cut back on your spending. Well, if you cut back on your spending, what have you just done to the economy, right? And then justifiably, it can be reported that the economy is getting worse. Well, it is getting worse. And then, of course, that makes you feel worse because you're hearing all the time, and then you cut back more, and you can get into this cycle that I'm certainly, that was my caveat, it's certainly not just the media. It's a cycle, but what the media, I think, did was amplify. And they have the ability to do that because you reach so many people so quickly.
So what's the solution to that? And then Karen, we'll move on to you. I mean, is the solution to, God forbid, turn off the TV?
Never.
No. Well, I'm actually curious, and I thought a lot about the solution, and I have one in mind, but if it's all right, before I hit the solution, I think, in fairness, to my colleagues on the panel, and it's such a unique opportunity to be able to ask you right here, I would love to know, what is your view on that, in terms of this contagion effect?
Can I answer that?
Sure.
So that is a great question, and I've learned so much from, I'm on a show on CNBC called Fast Money, which is a stupid name for a show. Maybe a lot of you had it on mute in your office. Anyway, so what I learned being on this show is CNBC is in the business of making news. They manufacture news. They produce and manufacture news, and they're not the only one. So we're now in this 24/7 news cycle, and there's more than one channel completely devoted to financial news. So how interesting is it, if you were to turn on the news and they were to say, fundamentally, there was really no change whatsoever in the valuation of any company that exists in the United States. Yet that's most likely what happened on each and every given day. So since CNBC and others are in the business of manufacturing news, you need there to be a shift, you need there to be a story. And so it is in the business of promoting and creating that. And I think the phenomenon that you talked about absolutely happened. I mean, for CNBC, the ratings went through the roof. That was phenomenal. Yet, so that you can see how people get sucked into that. And as someone who studies the market for a long time, you often have to weigh your own natural, I don't know what it is, intuition, whether it gets you sucked into it, versus trying to be an investor and saying, you know what, this is an opportunity. Likely, Young's business, for example, really isn't any different today than it was yesterday. So if I liked it at 48 and it's now 45, do I want to own it here? That's what you have to do. That's harder, but the media, no doubt, feeds into it.
And yet, and I want you to weigh in just a second, but for most individual investors, the trading, the frequent trading, hurts them more than it helps them. You know, we've seen stories that we buy the wrong things at the wrong time and we eat up our profits in commissions when we overtrade. And so for individuals, is the solution, and it's not just CNBC, by the way. I mean, I worked for many, many years at Money Magazine where the goal was just to generate more stock picks. That was what we needed to do to fill the pages. So is it better for the individual investor to read the big national headlines and not dive so deeply into the market news?
To me, I think it's the individual investor has to know themselves and know whether they are likely to be sucked into that vortex or not. If they are, then they shouldn't be acting on reading the news. You shouldn't be acting all the time. And if they are not sucked into it, then you can read it and find interesting things. That's why you've got to know yourself well.
My guess is that more people think that there's a latter kind of investment than actually
Yes.
are. But, you know, there's the media amplification is exactly the right word, because that's what the media is good at, is amplifying an effect and you know, building a snowball. What is the hardest thing in the world is to speak against the conventional wisdom and to convince people that things aren't the way that they think they are. You know, there were people writing about what was going to happen before it actually happened. There were people warning that, you know, we had a housing bubble, that the financial system was on a shaky foundation, and you just couldn't hear them because that wasn't the prevailing message. So, you know, it is an amplification effect, and it's hard to know what to do about it. It's the same problem we see in other areas where, you know, do you blame the buyer, do you blame the seller, in what proportions do you sort of divide responsibility? Do you ask people to listen less? Do you ask the media to talk less? I don't know what the solutions are, but I mean, the phenomenon, I think, is exactly right.
Well, and so from a solution perspective, from an emotional intelligence perspective, there are a couple things, and Karen, to your point, I mean, the first thing that I advise is self-awareness. Stopping for a moment and saying, okay, wait, what do I really feel here? Because a lot of times I'm asked, well, how do I stop contagion? And in this case, we're talking about in large financial markets, contagion also occurs in workplaces. You know, that bad apple that's infecting everybody else. Well, you know, how do you stop that? And so the first way to stop that is, and it's actually somewhat simple, which is you have to know it exists. I mean, one of the reasons I actually wanted to be on this panel, and you said, Binyamin, about how some people are writing about it, but you don't hear them. I was so excited in the midst of the crisis. I got a call from a Wall Street Journal reporter, and she had heard about Contagion, and she wanted to hear about this. And I dropped everything. I'm like, great, I can, I know I'm at Wharton, I can have impact, right? I didn't think I was gonna single-handedly stop the crisis, but I thought maybe something, right? So I give this interview, and I'm so excited. It's not the first time I've given an interview, but I'm particularly excited about this interview. I get the Wall Street Journal, well, I got it online, but I get the, and what winds up being, I had imagined it told, my husband and Kim, oh, it's gonna be, I'm thinking a front page, like, Contagion, stops. It was, I think, page 11, and it was in like an advice column. It was, and it was good advice, but it was clearly buried. And so this is something I'm really very passionate about, because I think, my hope would be that, if nothing else, when you leave the room, if you understand this idea that contagion really does operate on you, to your point of the investors who think they're so rational, we all do, but I'm telling you, the research shows that it affects you and you don't realize it. If you're alert to it, so the first step is be self-aware and say, how much am I actually being influenced by this? The second step is just to get very, very analytic. And to look and say, all right, to the best of my estimation, am I in the right place? What do I need to do to really try to use your emotions to actually help you think? And that's actually what being emotionally intelligent is. It's not about being emotional. It's about using your emotions to help you think and to realize, okay, I'm really anxious, so when I'm thinking about what I'm about to do with my portfolio, I really kind of want to sell, but I know that's not a great idea because it's probably not as bad as all that. And getting the advice on that. And then finally, you know, regulating and being able to regulate yourself. And it's sort of the equivalent, if you think about, like, if, you know, when there was the big virus that was out there, the H1N1, even though you know it's out there, that doesn't mean you stop going into the street or going about your business. It just means you have to know it exists and you have to think about protecting yourself. And psychologically, the way you protect yourself with this, it's awareness and trying to then be as rational as possible and not doing everything your friends do or the media tells you.
If I could put that word in defense of the media, I think that, you know, the better you understand the situation, the less like you are to overreact to a new development. So, you know, that's the good thing the media does, hopefully, is it helps people to understand the fundamentals of situations so that they're not overreacting.
I'm going to open it up for your questions in just a minute, but there have been a couple of things in the news recently, the last couple of weeks, that I just want to ask you guys to hit on in terms of how they affect us, how they affect our money, how they affect us going forward, so that maybe we can react or not, if not reacting is the right thing to do. The debt ceiling. We've heard a lot about the debt ceiling, and Tim Geithner has said that he expects U.S. borrowing to hit the debt ceiling right about now on Monday, but he can use quote-unquote extraordinary measures to keep us out of default until the 2nd of August. Do we do anything? What do we do?
We're fine until the 2nd of August. That's basically, the debt ceiling is the national credit card limit. It's the maximum amount of money the government can borrow at any one time. We're going to hit that limit on Monday. At which point the government, which spends about $120 billion more each month than it takes in revenue, needs to find that money somewhere else. And what Secretary Geithner is basically saying is that until August, he can find that money somewhere else. So we're fine for the time being. What happens on August 2nd? There's a range of opinions about that. None of them are too good. Congress can raise the debt ceiling. That's the best solution. Hopefully that happens. If it doesn't, the government will either need to make some extraordinarily difficult choices about which bills to pay, or default on its debts. Either of those paths would have profoundly negative economic consequences. Ben Bernanke, the chairman of the Federal Reserve, has said that it is his belief that it would be worse than the 2008 financial crisis. So it wouldn't be good.
Karen, are you playing this in any sort of a way?
I'm not, because I do think that there will be enough, that Bernanke and others will have enough sway that they will get together and raise the debt ceiling. I hate that it's a political football right now that each side is just trying to use to further their own agenda. I hate that. It's dangerous and it's stupid. But at the end of the day, I think we'll get there. I do think, though, that the S&P downgrade of the U.S. debt we may look back on that a couple of years from now as the first sign. And I continue to think that the dollar will be under pressure no longer.
We talked a little bit about silver, but let's go back to gold and silver and other commodities. They have fallen. Is now the time to buy if we don't have them in our portfolio, and should we all have them in our portfolio?
I think we should probably have some. I personally like energy. I don't know if there are gold bugs in here. I don't own gold. I don't know if you know Charlie Munger is. He's Warren Buffett's partner, and he says, if you're a rational thinking human being and you own gold, because gold has no actual uses, you may be right, but you're still a jerk. That's his view on gold. I don't own gold. It's like religion. Either you believe or you don't. I guess I don't. But we do own oil-related stuff because I do think that the world economies will continue to grow, and I do think there will be a need for energy. And so that's how we get our exposure. The gold-silver trade is just not for me.
And how about oil? I mean, I have a 16-year-old who now has to pay for his own gas, and he's very upset.
That's a great lesson.
Oh, it's a great lesson. But, you know, we've heard about $5 and $6 gas. In my neighborhood, it is $4.50. It hasn't come back down. What are you looking at through the summer?
I think that because I think retail has been surprisingly resilient to that move. But I think in the last 2 days, gas has dropped dramatically. I don't know if I don't know how closely your son follows it at the pump. That is such a good thing, though. So you probably learned so much from that. I think if it moves slowly up, we absorb it without too much of a hiccup until it gets probably to around 120. Then that starts to really be problematic. But I think this time the auto companies are so much in a better position than they were last time, when they had an offering of SUVs that got 12 miles to the gallon. Now you have a whole different array. So some companies are in a much better position to handle it, like GM.
Well, and I heard on the radio today when I was driving down that the resale value on a 2008 Prius is now $4,000 higher than it was at this point last year. Housing, big issue. I know for me, I bought my house in 2005. The week the market hit its highs. It will never be worth what it was then, but I really don't like to hear that it's going to be worth significantly less than it is now. And yet you've been covering Fannie and Freddie. Explain to all of us what's going on and how is that going to impact our housing prices?
You know, housing is sort of the primary example of what we were talking about before. We had a system that was doing something that was not at all sustainable, and we're not yet at a new baseline. Fannie and Freddie, as I'm sure most of you know, are government chartered companies that basically provide money for mortgages, and they provided money for a lot of really bad mortgages, and as those losses rolled up, taxpayers had to bail them out. They're still the primary source of financing for the mortgage market. In fact, the government now provides about 9 out of every $10 used to buy homes in America comes from the federal government. So, you know, I was listening to Ben and Karen was talking about how markets have recovered. One market that hasn't recovered is the mortgage finance market. And the reason is that investors still don't see it as a good use of money. It's still not set up to work in a way that they feel comfortable that they're getting the returns they need without exposing themselves to undue risk. We need to find some way of creating a system that will convince people to make mortgage loans. We haven't done it yet. We have a huge backlog of housing, a huge number of foreclosed homes, vacant properties that were purchased for investment, and until that clears, and until it's possible to get a mortgage loan again without getting the money directly from the federal government, there's no reason to believe we're going to see a recovery in housing. You know, you can go to parts of this country that are really just amazing to see, the suburbs of Phoenix or Las Vegas or the Central Valley in California. I mean, it's almost worth going as a tourist experience. The just vast tracts of land with identical homes, empty or filled with renters or just decaying back into the ground. It's just really amazing to see the scale of what happened and the scale of what needs to fade away before we'll be back at a sustainable basis.
Last question from me, and then we will open it up for all of your questions. As you look ahead to your areas of expertise, your individual areas, what advice can you give to all of us in order to help ensure that we can increase the size of our nest eggs and be better off next year than we are right now? And Sigal, I'll start with you.
Sure, although I have to say I'm incredibly depressed at this
Well, I want a little rainbows and sunshine.
Yeah, you know.
Just smile. Just smile.
Yeah, just smile. And I'm feeling better. You know, there was a very interesting study just done with Vanguard, actually, with investors in Vanguard and some researchers, including Peter Salovey, who really is the person who came up with the concept of emotional intelligence. Dan Goldman did a fabulous job kind of bringing it out to the public, but Peter Salovey was the original researcher with it. And the idea behind that is, as I was saying before, is that we can use our emotions to make us smarter. Like that's fundamentally the idea of emotional intelligence. And what they found in this study was that people who were more investors who were more emotionally intelligent, basically traded less, diversified more, and were pretty comfortable about, they paid their bills, they didn't, leverage themselves out crazy, they stayed more in the middle. And people who were lower in emotional intelligence, and there's some wonderful scales to be able to figure out where you stand in this, tended to do the opposite. So they traded a lot more, they went much more volatile, and so it's not very sexy advice particularly, but at least from this study, what it showed is that people who are better at regulating their emotions to help them think better, they tended to stay kind of more solidly in the middle. And that when you look, and then what they did is they looked at their outcomes over the course of about 6 years, and they were better. Now again, they weren't getting these huge returns, but they also weren't getting the losses. So that's one thing that you could do, which is you sort of try to regulate your own emotions, not get overly depressed. We're not going to fix the debt thing today. Like, I mean, there's not. I wouldn't go out and start trading on that unless you're very good at that. And so that's one thing that you could do is you try to stay in control of your emotions and stay rational.
Ms. Sunshine, you want to go next? I actually want to echo what she's saying, being diversified, so that you're going to have parts of your portfolio that will move a lot. If you happen to have energy, it will move a lot up and down. There's great volatility. If you own names like Young or Philip Morris, good dividend pairs, good growers, good multinationals, they won't move a lot. They'll have a nice return. But it's not going to be super sexy, but that diversification will serve you well so that you can be rational and make good decisions. Just what you're saying.
I think the most important thing to understand about the American economy is that for most of the 2000s we were growing like this, and then the financial crisis came and dropped us down here. We're now growing at the same pace again, but on a lower parallel, okay? And there's an increment of wealth there that is never coming back. That portion of the economy is just gone. So, if you're thinking about the future, I guess adjusting expectations is the thing to do. It's not the most pleasant message, but we lost something that we're not getting back. And, that obviously impacts different people differently. There are people who, profited from this. My career has actually done really well during this crisis. But on
That's
the whole,
Wharton way.
But on the whole, I think reducing expectations is probably the order today.
Reducing expectations, and I think, and I'm just going to weigh in here and answer the question myself, saving more money is the other thing that we can do. And the only way to save that works consistently for most people is to do it automatically. We're starting to finally get some really good research on what happens to people when their companies automate them into retirement plans. And instead of allowing you to decide whether you want to be in, they just put you in, and then they auto-escalate your contribution every single year. Those people, 80% of them, 90% of them are going to have enough money for retirement. For people who are not in plans like this, only 50% are going to have enough for retirement. So whatever you can do, whatever mind games you can play with yourself to psych yourself into saving more money, they're all really good things. And now we will open it up and answer your questions. Yes, sir.
Yeah, I just want to make one comment and then ask a question. Jean, I think, asked what you can do to protect yourself. And someone said get a trusted advisor. And so I'd like to mention early in the 1990s, Karen started a fund.
It's my uncle, by the way.
I was going to say it. But that's the function, right? So you took it away. Thank you,
I'm sorry.
But, and so my children and I invested with her, and they've been ups and downs, and later on my wife too. And through it all, it's up about 7 times, which is not so bad. So that's something to trust. But I did want to ask.
All right, just the way we practice.
I did wonder if the panel would comment a little bit about the effects of leverage on the markets and what's happened in the last couple of years. Karen gave the example of silver. So if you bought silver 2 weeks ago, let's say you put 50,000 in, as we listened to the panel, we decided to diversify in commodities, and that was the way we were going to do it. and now we have 33, and if I leveraged it 2 to 1, now I have 0 with my investment. That's what happens to leverage, and so maybe the panel could talk a little about the effects of that, particularly on some of the financial institutions and the prop desks and the rest of the economy.
I think it's only appropriate that we let Karen go first.
Leverage. I don't even know where to start. I mean, the idea of buying a silver ETF that's up, however much it was up, 100% in 6 months, levered, is so scary to me and so shocking. Yet people do it all the time. I mean, that's it. That is the kind of risk taking that creates enormous wealth for a very few, and it creates tremendous losses for everybody else. I do just we never run a levered book. Once you have, in 1987 or it was the late 80s, there was another sort of mini crash in '89. We had a portfolio in a different fund that was levered, and when you get a margin call in the midst of a horrific market where you have to sell, regardless of price, that is, you have no ability to ride out the storm. That is a lesson that you hopefully learn one time only, and you never need to learn it again. You will never run a levered book.
I'm wondering if people have actually learned the lesson when it comes to their own homes.
Find out.
Yes, sir.
When as a boomer, we know from statistics we've read that there is a lot of pent-up wealth that's going to be passed from our parents to us or from us to our children. That's going to let loose with a large flood of money, notwithstanding some of the recent setbacks. What's your views on how that might affect what's happening in the markets when people are going to go searching for yield or return?
Well, I've heard of that phenomenon happening for a while, and I haven't really seen it yet. I think some of the other factors are much bigger, like something like a financial crisis. You have, I think, a generation of investors who are afraid to invest in the markets. I don't know if you found that, Gina.
Well, absolutely, but I think what we're starting to see now, they were talking about this multi-trillion-dollar transfer of wealth for many, many years. And now the problem is that people are just living so long. We've got longevity along with interest rates and inflation are it's a risk. And there are academics who are questioning whether that transfer will happen. So I think we have to wait and see.
I want to congratulate you. A very lucid presentation by all of you. I would like to make a comment. It seems that the concept of ethics, once again, has been left out of all of your discussions because, they just had the situation with Gallion, for instance, who was, I forget his name, I can't pronounce it.
Raj.
He's a Wharton graduate. Raj, yeah, he's a Wharton graduate.
That was not said a lot in the press.
No.
I saw that. But the discussion was not from Wall Street to your wallet. It should have been from your wallet to Wall Street. The title of this. My question is that the whole concept of ethics. Sigal, you do in your business, you sell a service to the financial community to figure out what hot buttons to push to the investor, to teach these fellows how to...
No, actually, what I mean, the goal the goal from, I think, their perspective is for them to better understand how they can behave with investors, although I'm risking sounding like Vanguard spokesperson here, but how they can better understand their investors so that they can meet their needs better, and ultimately so that they can be better employees. Obviously, there are both, but I don't think I don't think that they view it as how can we manipulate people into.
No, I worked in the financial community for 30 years at a major firm that was now under a hell of a lot of pressure. And people question the ethics, and I question them today. Karen, you're on television. Your company, and I don't mean to be accusatory, I'm just being observant.
No, please.
Your company is there to sell hype, activity. You said it yourself. You can't. Well, wait a minute. You're looking at me. What happens is the set, the way they have it set up, it's set up to be almost at a circus. The noise, you can tell the sound quality. Everything is there to get people on edge.
I take it he's not a family member?
No, I watch your show every day.
You do?
Yes, I absolutely.
You've just gone down 2 notches. Go
I
ahead.
listen to it, I watch it, I have it.
Do you have it on?
This whole concept of high-speed trading. Goldman Sachs won a big settlement because the fellow that was working there stole the ideas on how to figure out how to do the high-speed trading. Well, high-speed trading, in my opinion, is front-running, right?
Yes.
That was illegal many years ago. People got fired all the time for front-running, for buying and selling options based upon what they, 6 million shares of whatever it's going to do. The silly season in silver. You were talking about it before, the silly season, the silver trade. Microsoft just went out and bought, paid an enormous amount of money for Skype. $6 billion. Yeah, they could have
$8
spent
billion.
$8 billion. They could have spent $2 billion.
Yeah.
The difference is with Microsoft doing that is that they did it with cash. They don't have to borrow. They can wait it out.
I think it was a stupid transaction anyway, but you know.
Well, no, what are you suggesting?
What am I saying? What am I saying is that I'm saying that the ethical situation, maybe Microsoft isn't the right word because I had it on the list, but the ethics that people are taught or live by tend to feed on into this cycle. We're going up, we go down, we go up, we go down. Everybody knows you shouldn't borrow more than they can pay back, but they do it.
Well, not only do they do it, but that there were institutions that allowed them to do it. And I don't think that you can put the culpability on the individual completely.
You can't put it on the individual. I don't want to monopolize this, but go back to Bernie Madoff. Okay, here's a situation where people say, well, why did everybody just follow the leader? Because they belong to the country club down in Florida, and this one does that one, and they're too lazy to figure out and ask the right questions. Not stupid so much, but lazy. Because there were a lot of smart people that got completely hoodwinked. So,
Absolutely.
The ethics, there's so many bad people out there. And it almost feels like it's being taught in the schools.
Well, actually, I think a lot of schools are now teaching ethics, correct? I mean, we're teaching it here.
No, you're raising a critical point. I think what you have to be careful of is not to confound a firm's desire and ability to make money and employees' desire and ability to do their job well as absolutely correlated with unethical behavior, right? So the ability to make money is not inherently unethical. Because I think some of the underlying premise you're giving almost sounds like that. Now, having said that, though, unquestionably, there's something that went very awry on Wall Street with ethics. I think, Jean, your point is also very interesting, which is it's not only the individuals, but it's also something about the organizational culture, the structure, the way things were set up, that it wasn't even that they were allowed to happen. In some cases, they were encouraged to happen. And we could get into an interesting debate, and as academics we do, how much of this is the person, how much of this is the organization. I can tell you something that's very disheartening, by the way, in terms of schooling. So at Wharton, we absolutely have ethics courses. I am the course head for our introductory teamwork and leadership class for all of the MBAs. So they do a 1-week very intensive simulation that my colleague Nancy Rothbard and I wrote, and as part of it, we have kind of an ethics piece. I'm never very happy about how that goes. And there's actually been research that has shown, they compared English majors, business majors, and I think history maybe, and they looked at ethical behavior and perspectives, and very upsettingly, the business students cheat more, and they show less ethical inclinations. So we definitely have something to do, and I don't think that that should be dismissed, but I also want to hold constant the idea that this is all just bad people or bad teaching. There is something systemic that allows it to happen that I think that we need to deal with.
Yes.
The estate tax exemption is subject to change the end of next year. Have any of you heard anything other than what we generally hear in the real world relative to what that figure might be?
I'll just say that, I think the entirety of sort of the tax code and what happens to the question whether we're going to see a substantial tax reform really depends on the outcome of the next election. That's the simple answer. This next election is going to be in some sense a referendum on the approach to dealing with the government's financial problems. That's obviously a component of that, and it will determine the direction of that.
When I came in, you were talking about protecting yourself, and you were talking about diversification. What happens when we've got CEOs of one company who are sitting on a board of another company?
Absolutely.
And, there's all sorts of cross-company things going on that's all behind the scenes. And how do I protect myself from that?
Sure.
I mean, right now we've got an oil company CEO who's down there in Washington getting beat up on, who's sitting on a board of another company, a large multinational company, and they got beat up about 10 years ago. I mean, how do I protect myself? Other than vote no on the annual elections.
I don't have the answer to that. I don't have the answer to that.
No.
Other than diversifying, you're going to have individual risks everywhere.
Well, and to know the management, to make as much of an effort as you can to get to know the people that are managing the company. I mean, the information, because of the internet, is more out there than it has ever been before. And so it is accessible if you feel like taking the time to do the research and do the homework. I just was on a panel that was discussing trying to get more women on corporate boards, with women who sit on the boards of Coca-Cola and AOL, and increasingly the problem is that there is so much potential liability that qualified people no longer want to do the job. So the tables have really turned.
And the other, one other
I
thing.
just know that it's not like qualified people were doing the job in these cases. They were sitting there and collecting large checks and doing, not much of anything. So it's not like we created a problem.
Well, and one other point to this is this idea of public outrage. So one of the things, for example, we know from the research literature is that if you have interlocking board of directorates, the CEOs make much more money, which it's not hard to figure out why, right? And I think a lot, and this, by the way, the press has been really helpful with, so I guess maybe it depends on what you want, is more public outrage, saying this is not okay. I mean, a lot of what we heard when the government tried to say to the companies that they gave money to, well, you can only get this much pay, was tremendous outrage from those companies and saying, we're gonna lose our best people, and we can't take this. Well, if the public says, look, we're footing the bill for it, and we won't do it, it's a longer term. It doesn't help you today, but it might help with some of the protections.
For a long time, the government has encouraged home ownership through tax planning and funding. Do you see home ownership as part of the American dreams economically and psychologically in the future?
It's clearly the case that most Americans feel that way, and it's hard to imagine it changing. It's been true for a very, very long time. It's deeply ingrained in our cultural fabric, to the point where if you try to raise it, it's almost an issue that people are uncomfortable confronting and thinking about. It's so deeply necessary to their understanding of what it is to be American that they won't even sort of consider the possibility of what it would mean if we stepped away from that embrace. Whether or not that should be the case is a wholly different question, but if you're asking me, do I think it's going to change, both for that reason and because the lobbies that benefit from it, the home builders, the realtors, the mortgage industry, are among the most powerful in Washington, there is absolutely no chance that you'll see significant change in those incentives.
In the back.
Yes, I teach occupational ethics at Drexel University. And this gentleman, first of all, needs to be applauded. I think his message was far more important than any other message that's been conveyed here today. And I would like to see more programs on the subject that this gentleman has raised, instead of people sitting in front of us trying to feed our egos and make us feel better.
Thank you.
For Karen, I read a number of articles about books about the Wall Street meltdown, and I mean there were a number of, and I'm coming from having also gotten a business education, got an MBA at night about 7 years ago, and I read about some of the things that were going on at Citibank and at Bear Stearns, and I'm absolutely flabbergasted and dismayed about some of the things that were going on. Has that changed in the last 3 years since the meltdown of the economy?
I think it has changed. I think that much of the Dodd-Frank bill is sort of addressing how much leverage there can be, but it is a cycle that we've seen again and again. If you ever read, you probably read Galbraith's book, Panic and, I forget what it's called, Panic and Euphoria or something like that. The same cycle will happen again and again. Maybe it won't be with mortgage-backed securities. Maybe it'll be...
They'll find a new idiot.
They'll find a new thing. If you read that Galbraith's book and you just take out whatever the mania was at the time, starting with tulip mania, you know, through whatever it was, all the way to the internet crisis to the last crisis, it will happen again, I have no doubt. Leverage will find a way back into the system. And it's always leverage at the end of the day. It will happen again.
We'll take one more.
Okay, I'm supposed to lob an easy one for Karen, but I'm going to ask
She's
Jean.
my aunt.
Karen's not related to Karen.
Okay, but I'm going to ask Jean, what is a safe, because the housing industry is an important part of our economy, and owning your own house is an important part of people's psychic. What is a safe level of leverage, and what are some of the benchmarks?
I think in your own life, well, in your own life, you want to look at buying a house that you can truly afford, which doesn't mean a house where you can afford the mortgage payment. If the mortgage payment has you at a level where you are not comfortable, you know, spending extra money to fix the roof, if that happens, that's too much leverage. And so, you know, a ballpark for people, money spent on housing, 35% is a pretty good amount of take-home pay, but you've got to look at it in the scheme of the rest of your life and your other responsibilities and your other obligations. And when it comes down to buying a house right now and borrowing for that house right now, based on the things that Vinny was saying earlier, I don't think people should buy unless they're going to be there 5 years or more, because it is very possibly a losing proposition.
Fannie Mae and Freddie Mac used to require what was called a 28-36 ratio, meaning no more than 28% of your income on housing expenses, no more than 36% on fixed debt payments. A lot of research went into that, a lot of study, made a lot of sense. They moved away from it, but it's still the best numbers I know.
Well, and not only did they move away from it, they were allowing up to 55 or 60%. So incredible. I'm going to say thank you for coming.